brand new week, and it's starting with me in Lagos. Good to be back right here in the studio in Lagos. Good morning, everyone. This is 55 minutes of current and relevant business conversations. That's what we do on Business Morning. I'm Ini John McCall. We start as usual from the global space where oil prices fell on Monday as an easing of geopolitical risks in the Middle East and the prospect of another OPEC Plus output hike in August improve supply expectations amid persistent uncertainty over the outlook for global demand. Look at the numbers for this morning. It's in red, 0.32% for Brent to $67.55 a barrel, also down more than that for WTI, 0.53%, and that's brought it down to $65.17 a barrel. The more active September contract was at $66.62 after it lost 18 cents for this morning. Of course, we know the factors driving all of this. A 12-day war that started with Israel targeting Iran's nuclear facilities on June 13 pushed up Brent's prices, which surged over $80 a barrel after the U.S. bombed Iran's nuclear facilities, and then it slumped to 67 after President Donald Trump announced an Israel-Iran ceasefire. OPEC Plus is meeting on the 6th. That's, I think, next week, because tomorrow is the 1st of July. And this would be the 5th monthly increase since the group started unwinding production cuts in April. However, bearish pressure from concerns over slower global oil demand, particularly from China, is likely to persist. China's factory activity contracted for a third straight month in June as weak domestic demand and faltering exports weighed on manufacturers amid U.S. trade uncertainty. Still around oil, but back in Nigeria, Dangote Petroleum Refinery has invested over 720 billion naira to implement its landmark initiative of deploying 4,000 compressed natural gas-powered trucks for the nationwide distribution of petroleum products, which is expected to save Nigerians over 1.7 trillion naira annually. And this is expected to absorb over 1.07 trillion naira in fuel distribution costs. The initiative is poised to significantly benefit over 42 million micro, small, and medium enterprises at MSMEs by reducing energy costs and enhancing profitability. The initiative, which eliminates transportation costs for fuel marketers and large-scale consumers, is expected to help reduce pump price and inflation. It's supposed to start from August 15. Dangote says it will begin that direct delivery of petrol and diesel to filling stations, industrial facilities, and other high-volume consumers. According to a statement from the refinery, it aims to meet Nigeria's daily consumption of 65 million liters of refined petroleum products. This includes 45 million liters of premium motor spirits, 15 million liters of diesel, and 5 million liters of aviation fuel. With the average logistics cost estimated at 45 naira per liter, the refinery is set to cover that over 1 trillion naira annually in free distribution expenses. And this, they say, costs Dangote over 720 billion naira. Now we move to the government now to address mounting concerns from Nigeria's private sector. The Federal Ministry of Industry, Trade and Investment has announced a temporary halt to the implementation of contentious provisions in the Financial Reporting Council. And this is contained in a statement signed by the FMITI Minister, Dr. Jumoke Oduwole. It was released yesterday over the weekend. And according to the statement, the decision is to suspend the dues following extensive stakeholder consultations, and it's accompanied by a new directive to cap annual dues for large private companies classified as public interest entities. The amendment enacted in 2023 introduced annual dues ranging from 0.02% to 0.05% of company turnover, with no upper ceiling for certain private firms reclassified as PIs. In contrast, publicly quoted companies are to pay a fixed 25 million naira annually. The asymmetry in financial obligations sparked strong opposition from leading business associations who warn of severe implications for cost management, regulatory fairness, and investor sentiment. Still staying with the federal government, Nigeria's promissory notes fell 15.6% quarter on quarter between December last year and March this year, and that's according to the Debt Management Office. Latest report from the DMO shows that the notes fell from 1.54 trillion naira to 1.3 trillion naira within the period, reflecting the federal government's recent effort to settle verified obligations and improve confidence among key stakeholders in the economy. The DMO report says that the amount also represents a 17.1% year-on-year decrease from March 2024 to March 2025. Last week, the federal government announced plans to clear outstanding payments owed contractors who have duly completed verified projects across ministries, departments, and agencies. Those are the MDAs. And talking about the private sector, a proper business model layout for interior decoration is also forming conversations as the country seeks to wean itself of depending solely on crude oil. And so a group of experts met in Lagos to share some tips for those intending to get into the interior decoration sector and those who are already there, how to boost their businesses.
Design because over the years, the industry has really grown. There has been urbanization across the country. I'm speaking from major cities, Abuja, Lagos, Port Harcourt, all of that. Even in the southeast as well, there's been a lot of development and urbanization. So the need for interior designers is highly imperative at this moment. We've realized that people want a specific design accustomed to their environment and how they feel, because interior design is more about creating an experience and making sure that you imbibe the culture and the style of every individual or every environment. My advice for individuals who want to dabble into this business is to understand the business and the structure, because creativity is not enough. You can be creative and you might not understand the factors that influence this industry. There's a whole lot of factors. We have the artisans, we have all of that. And speaking of artisans, we need to create more institutions to hone the skills for artisans, because they are the key part of production and, I mean, mostly execution, yes.
So a bit of what I was doing in Abuja last week, obviously, it was the coverage of the African Export-Import Bank. There's Afreximbank, their 32nd annual meeting, which produced a new president. I'll give you more gist about that tomorrow. But one outstanding thing that happened then was that the outgoing president of Afreximbank, Professor Benedict Rama, was conferred with a national honor by President Bola Tinubu, and that is captured in this report. The number of delegates participating seems sustained on the third day of the meeting. Afreximbank believes that the theme for the day is directly tied to regional and financial institutions' architecture.
The role of the institutions in helping to overcome those fractures is very critical. They are critical to restitute, to rebuild, and to seek what it is that we need to move our trade, to move the development ahead.
This line of thought is followed by the chairperson, African Union Commission, Mahmoud Ali Yusuf, who's represented by the deputy chairperson.
The question is not whether Africa can rise, but how we will make that rise on our own terms.
Then the conversation goes into sessions.
We are beginning to see government that understands business and government that does not feel threatened by business. Because what is good for business is good for citizens.
Africa is not the only place that you have corruption. Corruption is all over the place. The only difference is that our corrupt people, when they steal the money, they take it, they fly the money out of the continent.
The second half of the program welcomes Nigeria's President Bola Tinubu and his wife, Senator Oluremi Tinubu.
We have collectively, over the past decade, built a solid financial institution.
The host, The president of Afreximbank, Professor Benedict Rama, formally welcomes all and sets the tune for the ceremony. Being the final meeting for him as president, he assesses his time in the last 10 years.
Total revenues also rose sevenfold, reaching $3.24 billion from $408 million in 2015. Net income amounted to about $1 billion last year, about 700% increase from the level of $125 million in 2015.
His Excellency President Bola Ahmed Tinubu.
The speeches end with President Bola Tinubu. He shares the partnership between Nigeria and Afreximbank.
The world will not wait for Africa. A united and purposeful Africa can define its destiny. In the face of rising protectionism and shifting trade dynamics, it is more important than ever that we stand together, united in our commitment to Africa's development and prosperity, their own destiny.
And the president saved a surprise for the meeting.
I have the honor and privilege to recognize you. The outstanding contribution of Professor Benedict Rama by conferring you with one of Nigeria's highest honors, the Grand Commander of the Order of Niger.
John Mekwa. Also that. Professor Rama is now GCON in Nigeria, and a lot of people there actually do agree that it's well-deserved, looking at what he has done in a decade with Afreximbank and the impact that he has made on the continent. So it's a conversation that will continue. But so Dr. George Elomi was the first person to speak in that report, was then the executive vice chairman. Now he's the incoming president of Afreximbank. Obviously, on the third day, he was still the executive vice president, but now he's the incoming president of the bank, Dr. George Elomi. And other conversations that took place last week at the Afreximbank meeting is the issue of preferred credit status. So we've been talking about the formation of the Africa Credit Rating Agency, which is supposed to boost the status of African countries especially, and then looking inwards to the multinationals or multinational financials on the continent in Africa. Of course, that was also part of it. So I had to sit down with Purdy Crawford Chair in Business Law, Professor Labisi Akikugbe. He was on one of the panels having this conversation, so I decided to extract more from that with him during this sit-down interview.
I think you rightly said, the panel I was on was on African multilateral financial institutions, and part of the conversations that we had truly straddled two issues on the preferred creditor status question of African multilateral financial institutions, but also the credit rating troubles or challenges that a number of African financial institutions and African countries have been facing. So to go with the first one, which is the preferred credit status, that's a question that's really centered around a debate between African multilateral financial institutions like Afreximbank, Trade and Development Bank, amongst others, and then the Bretton Woods institutions, right, your IMF and your World Bank. And primarily, the argument on the side of the World Bank and IMF and other creditors that lend to African states is that an institution, a financial institution, is only gets a preferred creditor status if they are recognized as such by other creditors, right? For African multilateral financial institutions like Afreximbank, their own argument is simple. Our governments are sovereign in creating the treaty that established us, entrenched this, wrote this into the agreement, and therefore we're sorry. We have preferred credit status already. What that means is that you would have to characterize the loans that we give to these countries as part of the ranking loans that you'll have to pay. We don't take haircuts when it comes to restructuring of loans, right? And that's an issue which I think, as the panel also highlighted, from African-centered development perspective, is critical to the existence of these financial institutions. If you think about it, the recent trouble between Ghana, Finch, and the rating they did of Afreximbank, right, was in fact written that they may characterize Afreximbank's loan as junk, potentially, right? Of course, they've refuted that and they've written their statement. But if you think about that, what it means to an institution like Afreximbank to be characterized as such, or the rate at which loans will be procured by Ghana, which will be more expensive, they all come together, right, to create a bigger problem around the global financial architecture. But more importantly, it goes to the point of centering the role of African multilateral financial institutions, of which there's now an alliance of African multilateral financial institutions as well. So that's where we came from. The African Peer Review Mechanism and the African Credit Rating Agency is doing a very important work of making sure that agency gets off the ground and run very well. And I have no doubt, I think it will do that work very well. But there's also the fact that, more generally speaking, African financial institutions, more than ever, are driving the course of development of the continent, and we should not let anything distract from that goal.
Well, we're talking about African financial institutions. We seem to be raising hope and all of that, and Africa rating agencies. But can we say that we have the foundation already for us to start having these conversations, and not just because we are pushed to it?
The point is, these are all processes that have to run simultaneously. What we want to avoid is that in arguments about the reform of the global financial architecture, you don't want to inadvertently entrench a structural problem, right? What we're dealing with is structural in its nature, right? And so if we, for example, say we wait until when we have reformed the global financial architecture and not address other simultaneous issues, we will get there and we'll find out, oh, along the way we've probably led to the diminishing of the role of other core institutions. Where we are today in the world, the global system is stretched thin. There's the geopolitics of what is going on between the US and China and different parts of the world. What we're saying is that other institutions that used to hold true as those that drive the support, the funding that African states and others need, don't hold that any longer alone. There are regional development banks, multilateral development banks that are regional in nature that are doing important work. And so my argument, which I've made in writings, is that the reform of the multilateral financial institution is incomplete without a recognition, unfettered role of African or regional multilateral financial institutions. And that means you have to give them what they need to do the work they are doing, right? Which goes back to your first question around preferred creditor status as well. So in terms of thinking about, alternative rating agencies, protection of financial institutions on the continent, reform of the global financial architecture, addressing surcharge issues, they all run simultaneously. And the point is, we, African scholars, policy experts, NGO communities, must not leave one issue behind, right? We focus too much on the global and forget the regional. And by the time we're ready for the regional, it may be too late. That's what we're trying to avoid in this time.
So I guess we should say that charity begins at home. So let's deal with, our own complications and issues first. Have we started doing that, before we now put up all of this, putting everything together to try to solve the financial independence
Which
that
is why
we're
I said,
seeking.
everything goes at the same pace. I think charity begins at home describes a part of it. Don't take actions that inadvertently hurt the steps that are being taken at home, right? When a state, an African state, even though it's a contractual issue, outrightly says, oh no, we're not going to treat the loans that we got from African multilateral financial institutions like Afreximbank as deserving of private creditor status, you are hurting the institution. You're saying you don't care. It has ramifications for how that institution will lend to other African states if they will be able to do that. You see what I mean? At the same time, it doesn't mean we should close our eyes to what is going on globally, right? So you are right, there's a bit that is charity begins at home, but there's also part which is that it's a simultaneous process on which all hands must be on deck to support what everybody on the continent is doing in terms of what the AU, the African Peer Review Mechanism, the African Continental Free Trade Area Agreement, and African financial institutions, of which there is an alliance for African multilateral financial institutions, are all doing to make sure we move forward.
For an average African, I guess they'll say, where is the confidence in all of this, talking about Africa rating and all that? Because even before now, we've talked about the ECO, it hasn't really worked. AFCFTA, we haven't seen it working. Cross-border trading is still a challenge. Now we're talking about, depending on our financial institutions and also weaning ourselves off the Western institutions. I wonder where the confidence that this will work is coming from.
Maybe until 30 years ago or 35 years ago, the dominant narrative is we're just creating different kinds of organizations and different kinds of institutions. That narrative is gradually changing. The past 35, 30 years in Africa's international institution building has given a totally different kind of reckoning from the past several years. So for example, let's look at the regional economic communities, right? When they were first set up, many of them were set up without dispute settlement resolutions, no courts, right? But reforms that happened in the 90s changed all of that. And whether it's in the East African community or the ECOWAS community, a lot has happened by the courts. If you look at the trade pattern, right, until again, the 90s, the trend was that we don't trade with each other at all, right? The informal trading was not even accounted for. It's just failure everybody's talking about, right? But since then, people have written it, scholars have written about it. We trade in Africa, we just don't trade the way Europe trades, right? We still trade primary products, but you miss the informal economy that does more than that, right? It doesn't excuse the fact that we need to grow and trade more formally, for which we need to industrialize so that we can take advantage of value chain beyond just provision of raw materials. But we must also account for the modest progress that is happening along the way. If you put that aside, African financial institutions, their role in supporting these various initiatives, again, you look back at history, it looks like they haven't done anything at all. Some of them, not all of them, have been at the forefront, right, of trying to support initiatives. Pan-African payment systems, right? What the theme of this conference yesterday was all around, right? African trade and driving that resilience and what can be done, right? That narrative is changing. Does that mean we are where we want to get to? No, right? And so your question is, where should we look to for hope? I think we should look at the immediate 25, 30 years and see that our organizations are more intentional about what they're doing. Organizations like Afreximbank, like Trade and Development Bank, are putting their money where their mouth is. They are actually financing development-related projects, which will chart the course of the future, which will change the course of the future. That's where we need to focus on, right? And that's where I think we can draw inspiration in saying the vision we want of Africa 2063, the Agenda 2060, won't come if it's being financed by the EU. It won't come if it's being financed by the US or any other organization. And so this moment, the fracture in the global space for which some African financial institutions are stepping in, must be embraced by African sovereigns to give them the support that they need to continue to do those things that they need to do. And I hope that's a trajectory that we'll continue to have.
While Africa is seeking independence, then we see a country like China presenting a no-tariff policy. And we see Europe expanding to sub-Saharan Africa. Nigeria just became a shareholder in their bank not long ago. Would you say these are distractions, or would you say there are ways to capture these and accelerate our journey to financial independence?
I think the first place to start is that we're building our own financial institutions doesn't mean African sovereigns can't deal, right, with China or other, creditors, right? So the point is that you have another alternative source, one that cares about it, right? So if they get the basis upon which they go into those kind of deals right, then there's no problem, right? If, for example, with China, if the terms are known, if there's transparency around how those agreements are concluded, there's no problem, right? We can see that, we can assess it for what of it is, we can ask questions, right? However, if the attitude of our governments is to hide information about the loan they've gotten from China, only to then go to financial institutions, African financial institutions, and ask for more loan, then that means, I'm sorry, you're not even starting, right? Because then they don't have the basis around which to be sure the rates at which you've committed to, that you pay what you pay, would actually be met. And that's why we see instances of restructuring and defaults happening, quite apart from other exogenous factors that make that possible. So I think, if they engage with China on their own terms and go into those agreements very well, that's fantastic. If African states don't sign bilateral trade agreements that, open up their environments in a way that decimates it, that's fantastic, right? If they go into, climate finance and think about the environment in core ways, not commercially packaged agreements that's meant to siphon, right, the natural resources that they have, that is fine. And that's where we all have to continue, right, to ask the right questions of the governments around accountability, around transparency at the national level now, right, so that the roles of the financial institutions and other regional institutions can somewhat be easier as well when they're dealing with these states.
And when we finish all these great conversations and knowledge sharing and ideas, every African will go back home and have to deal with the political leaders. Are they really committed to make these work? Because it all starts from there.
Well, that's the sad reality. A lot of this, depends on that very much flogged phrase, political will. We need that to happen. The leaders must show that they really mean what they say by doing it. And so you're right. We hope that that's what a lot of African leaders will do, that they'll be bold, that they will know that, we need to build resilience in going into this next set of turbulent times in the global economic space. But also, as I've said in the past, the role of citizens and good advocacy, asking the right questions of government, not just at the federal level. Start from the ones that are closer to you. You can make them accountable, right? By engaging with the offices of your appointed representatives in a very civil way. And if that hasn't happened, go to court, right? These institutions are there. They would eventually come through, even though it grinds quite slowly, as they say of the wheels of justice.
So I can see that you're really excited about, all this issue of African financial institutions and the Africa Credit Rating Agency. But I'm talking about the Africa Credit Rating Agency. How do we really make it work, devoid of sentiments that we've seen over the decades on the continent, and able to win the trust of not just Africans, but those outside the continent?
Number one is there's a need to have the right information out there. It's a world where between the AI, and platforms that have stopped fact-checking information, there's a significant level of disinformation out there. It doesn't take much to just get it out there. So for institutions that care about the work they do on the continent, whether it's about establishing the credit rating agency, whether it's about Alliance for African Multilateral Financial Institutions, whether it's about the African Center for Disease Control, everything that happens under the auspices of the African Union and beyond, it is critical to provide right information. Sources that are relatable with the children of this age as well, right? Information delivered to them in a way that makes them understand that from the amount a government asked any creditor for, down to your daily living, you are paying a particular amount of what the interest rate will be eventually. And actually, you may also be denied of the infrastructure that you need if you don't stay with the government in the right way, right? So that's number one that I would say in that context. Good information made available to the citizens is critical. But number two is also to ask oneself, to the extent that we have all these institutions, this is a financial related conference, but I've mentioned the African Control for Disease Center, building that cohesion, building that, right? Fragmentation has happened in the context of trade agreements. At the time we just entered into the AFCFTA, Kenya started negotiation of a bilateral with the US. Now that has been put on the back burner. But the point here is that African leaders must not lose focus of the fact that the ideals of Pan-Africanism, which is where I'll go to, which has suffered a lot in the face of various economic and national interests, still holds true for this continent in many areas. And at times when all Africans are trying to be on the table to draw us further, right, into these areas, one hopes that, at the African Union level, at the various regional institutions level that make decisions, they think about Africa and its future at this moment. That's the only way, right? Think African, and at individual levels also hopefully buy African, dress African, and so on and so forth.
Be African in and out. I guess that's what the prof is talking about. Professor Olabisi Akikugbe, the Pauli Crawford Chair in Business Law. I met him up at the Afreximbank meeting. Let's take a break now. When we come back from there, pension funds are now being used for alternative investment. It's a conversation we'll follow, but first of all, we'll tell you about that, a workshop that was held on that. But that's after the break right here on Business Morning. Please stay with us. Welcome back. It's still Business Morning right here on Channels Television. Talking about pension funds, we know that the bulk of the funds available in a country like the United States is from pensions. But it does seem like Nigeria hasn't been doing much with its pension funds. And so recently, PENCOM has brought it up on getting alternatives, investment opportunities or platforms for the funds instead of just leaving them lying fallow. So in Lagos, they had a workshop on investment in alternative assets for chairpersons of board investment strategy and risk management committees of pension fund administrators. They say it's to offer practical insight into the potential benefits of the alternative asset class and explore how pension funds can effectively leverage these opportunities to mitigate portfolio concentration risk, enhance investment returns, and achieve sustainable growth to realize the objective, where participants have been carefully selected to include decision makers from the investment and risk management component of PFAs. And we're caught up with two of them after the workshop.
And really is to see how we can increase our allocation to alternative assets, to look at the bottlenecks. What are the bottlenecks? What do we need to do? Have those discussions, get a better understanding of those asset classes, hear directly from asset owners, hear directly from advisors, from practitioners, and to see what needs to be done for pension funds to increase the allocation to these asset classes for the benefit of the nation as a whole.
The regulation of pension funds themselves. So for pension funds to be investing in real estate or infrastructure or private equity, we need some proper regulations, and we shall be discussing that. But beside that, we also need some proper regulations that allow the activities, the underlying activities, to be possible. For example, if we want to have a real estate activity, we need to have a property rights to be well defined. And as far as I understand, there is a lot of issues concerning property rights in Nigeria that need to be addressed. And therefore, we need to coordinate with some authority in the Nigerian government to address the issue of property rights. And the same will happen with infrastructure. Infrastructures will use some portions of land, and therefore we need to address the issue of property rights as well for the issue of infrastructure.
Well, since it is interesting to see attempts by PENCOM to, seek alternative investment classes for pension funds, but there's still some things to be settled, as there a suggestion of looking the way of property rights. Well, it's a very big circle, and all connected at the end of the day. It's a continuous conversation, and we'll certainly follow up with PENCOM on that. It would be nice to have the DG on the program one of these days. We'll talk to them, and hopefully we will get her on. But now let's get to the global space and see what Ladi has found out for us. It's a Monday, Ladi. I know you like to keep us abreast of what to expect.
Oh, yes, there's so much to expect. But before we go there, welcome back from Abuja. The Afreximbank AGM meeting, and definitely a lot has been said there. But what I'm going to ask you now is about, how was Abuja? Abuja people are always like, you Lagos people, I don't know how you guys manage in that Lagos. Is that still the case there in Abuja?
Yeah, it's still the case, Ladi. So Abuja, more roads for you to drive on, less traffic.
You can leave 5 minutes before your meeting to get there.
No distance is really so far away because you have the road. There are times pockets of traffic, but I mean, you cannot compare. I mean, imagine that you're going on 3rd Mainland Bridge at this time.
Let's not go there.
And you hardly have an alternative, but in Abuja, you have
so
alternative,
many roads.
Exactly. So I don't know if it was an error or if it's a punishment, but I love Lagos. This is my Lagos. And I met up with the governor of Lagos, right there, and we had a chat, and I said to him, they said Lagos is traffic, but that's where the money is.
That's where the money is.
So this is where I am.
And he's going to get rid of it, non-state actors.
Yes, he promised that.
Definitely. We're watching out for that. But let's go to the global space. Now, let's kick off with what to expect this week. Marketing, that's a market-moving data and, others. So we're seeing Fed speaks there. Austin Goolsbee, the president and CEO of the Federal Reserve Bank of Chicago, will participate in the moderation discussion there at the 2025 Aspen Ideas Festival. That's happening in Aspen, Colorado. Goolsbee is expected to discuss both employment and price stability, reaffirming the Fed's role in balancing job growth with inflation control. We'll get his perspective on interest rates, expectations. Investors want to know what next with that, and the timing of cuts, and ongoing U.S. labor market and inflation trends, how policy tools are calibrated according to evolving data. Then tomorrow, PMI watch there. It's a purchasing manager index season. Tomorrow we have a couple of them, out, like the Shenzhen China General Manufacturing PMI, HCOB Germany Manufacturing PMI, S&P Global UK Manufacturing PMI. We're also expecting Stanbic PMI right here in Nigeria, and also from the Central Bank of Nigeria, and others, for the month of June. The PMI is a timely, forward-looking indicator of industrial activity and overall GDP momentum. Stable 51.0 reading suggests, gradual improvement in production and new orders. Then we also have data from Tesla. They're set to release their June 2025 vehicle delivery figures. That's for July 2nd. This data will be a critical snapshot of the second quarter performance, expected to shed light on how the company is navigating mounting headwinds across key markets. We know the competition right there in Asia. Then as the U.S. prepares for the release of the June non-farm payrolls data this Thursday, investor attention is laser focused on signs of a cooling job market amid persistent economic uncertainty. Consensus forecasts widely range between 95,000 and 130,000 jobs added, well below May's gain of 139,000 jobs, indicating a marked slowdown there. Let's look at the headlines from today now. We see German imports, their prices decreased by 1.1% year-on-year in May, according to data released by the German Statistics Office. That was out today. The decline was steeper than market expectations, and analysts polled had predicted a more modest decrease of about 0.8% for the month. There we see China's manufacturing sector contraction. We saw contraction in June, albeit a slightly less than expected pace, as local manufacturers they grappled with sluggish overseas demand amid relatively high U.S. trade tariffs. The Manufacturing Purchasing Managers Index, that read about 49.7 points in June, and that's data from the National Bureau of Statistics. And the print was slightly better than expectations of 49.6 and improved from the 49.5 points seen in the prior month there. And we see Canada, they scrapped its digital services tax targeting U.S. technology firms. That was late yesterday, just hours before it was due to take effect. In a bid to advance stalled trade negotiations with the United States, Canadian Prime Minister Mark Carney and U.S. President Donald Trump, they will resume trade negotiations in order to agree on a deal by July 21st, and that's according to Canada's Finance Ministry there. Also, we see the U.S. dollar that dipped to start the week, remaining close to multi-year lows and weighed by optimism over trade deals as growing expectations of the Federal Reserve cutting interest rates in the near future. We see, and early today, you see the dollar index, which tracks the greenback against a basket of 6 other currencies. That dropped 0.2% to 96.81 points, close to its lowest level since March 2022, on track for a hefty 2.6% decline. And that's for June. All right, let's get a check on what's happening in the UK now. Let's get a sense of what to expect in the week. That's for market-moving data and this week. And some of the headlines we see out this morning. Joining us now, we have Juliana Olayinka, our London correspondent. Great to have you, Juliana. Happy New Week.
Hey, Laddie, it's good to be here.
Yeah, good to have you, Juliana. So we have that news that the US-UK trade deal, that takes effect today. I believe focus is on British car exports and aerospace components.
Yeah, that's absolutely right. It's not a sweeping free trade agreement, but in today's pretty fractured global economy, targeted tariff cuts can carry serious geopolitical weight. So there's no surprises it's dominating headlines here in the UK this morning. Now, the UK-US trade agreement was signed at this month's G7 summit, and it's now officially come into force. And what it basically does, it reduces import duties on a number of strategic British exports, particularly, as you quite rightly said, around cars and aerospace parts. Basically, companies like Jaguar Land Rover can export up to 100,000 vehicles every single year to America at a reduced 10% tariff. This is quite a significant drop because the rate was actually at 27.5%. And that's what was imposed a couple of months ago. Also, this affects tariffs on aerospace goods as well. So this includes engine and aircraft parts. They've actually been cut to zero tariffs. So Prime Minister Keir Starmer has described the deal as a historic agreement. And as I said, you know, there is still more to be done. There is still more I's to be dotted, T's to be crossed. No feedback on what's happening with steel and aluminium, which, to be fair, when these tariffs were first touted, those were the major concerns, and I think that that deal remains deadlocked. But a large swathe of British business can breathe a huge sigh of relief this morning. Any sort of breakthrough with Trump, as you know, Laddie, is a big deal.
Right, and talking about a sigh of relief right now, from all you've seen so far, do you think the UK is out of the woods when it comes to trade spats with the US?
It does appear that way. As I said, geopolitics is so fragmented at the moment, so any sort of breakthrough on a trade agreement is good. And I saw at the G7 in Ottawa a couple of weeks ago, Sir Keir Starmer was still very much in favour with Donald Trump. I don't know if you remember those scenes of the actual agreement and falling on the floor, and Sir Keir Starmer got on his knees. Optics are very important, as we know, in this business. So, yes, it does appear as if, we are kind of out of the woods, but there's a long way to go. Positive signs, but there is still lots of the agreement to be negotiated.
Right, we'll definitely keep tracking all of that, but we're still having data out today. It shows that's the UK economy growth there, confirmed at 0.7%. That's for the first quarter. How's this data being received over there?
Yeah, this is positive news, as you say. According to the Office for National Statistics, the UK economy grew by 0.7%. In Q1, and that's the fastest pace of growth in over 12 months. It's good to be optimistic, but economists are already warning that the momentum may already be fading. And that's because we had data showing that the economy shrank by 0.3% in April. So this Q1 data is very much looking at the rearview mirror, not looking straight ahead. But if we do look at that data, it does show that early on in the year, there was a rush of consumer spending as people try to beat new tax increases and, of course, those looming US tariffs. There's also a spike in house purchases, and that's because there was a property tax break expiring at the end of the fiscal year, so lots of people rushed their purchases. Manufacturers also were pushing to be ahead of Trump's trade deadlines. So that's what it appears to have been. Is confidence here in the UK? It does appear that way. Of course, it's quite a cold, gloomy island, so when the weather is shining, people are out. Hospitality is huge, so you've got lots of the pubs and the bars out and about with people. But there is, again, a long way to go with the UK economy. There have been some concessions as well, and some pretty monumental U-turns from the Prime Minister over the weekend. So lots of debate about whether or not his fiscal policies are aligned with the trajectory of where the country needs to be going in. We'll just have to wait and see.
Yeah, and talking about waiting and seeing at this point, it's a brand new, fresh week, and investors definitely be looking out for those market-moving data pronouncements coming out of the UK. What are you seeing coming?
Yes, it's, would I say quiet? Quite quiet here in the UK. We've got some data out. I think what's going to be important tomorrow is we have the Bank of England Governor Andrew Bailey giving a speech. He's always got some insights. It'll be interesting to see what he thinks about what's happening with geopolitics and trade disputes. And then we've got the S&P global composite data, having a look at June, which is quite important because that provides a forensic look over services, manufacturing and production. I think globally, everyone's looking towards US non-farm payroll data out on Friday. And then OPEC Plus are having a ministers' meeting. Really important to have a look at global oil prices, as always, Laddie.
Yeah, definitely so much to look out for there. Thank you so much, Juliana, for breaking it down for us. Thank you.
Thanks, Laddie.
All right, so in a day have it, there's so much to expect this week. I believe today, the top central bankers, they're meeting, in Portugal, and, top on the agenda is, geopolitics, inflation, how to keep, global inflation, stable, what we're seeing playing out. And I'm sure they'll also be talking about the relationship between Donald Trump and Fed Chair Jerome Powell, with all those name calling, that we've seen. so far. So I'm sure enough to talk about, today.
Yeah, well, there's a whole lot, and Jerome Powell obviously is at the middle of all of it. But
right.
I think Jerome Powell will just be, well, I have a shadow,
Right.
The talks of the end of my tenure is closed.
Yeah, that's close. Yeah.
So, I mean, let me just do my best and hand
right.
over. And the American people will see that I fought as much as I could.
Right.
And whatever comes after that, well, it's not my fault.
Exactly.
So, I mean, and I guess once we have a new Fed chair, the first thing would be a cut. But what would that do to the economy? We see the dollar, since last week, we've seen the dollar trending down.
Yeah, that's been going down. And I believe Trump likes that, I think, because we know how, China has been able to use currency,
devaluation to attract
get
more imports.
All their products out there with exports. So maybe he might be trying to play that same strategy, at this point.
Well, President Trump is a wonderful man.
Yes.
I don't know if you saw that session that we had with Mr. Mills, a former advisor of President Trump, where he says, if you want to go into a meeting with President Trump, first of all, you have to follow Truth Social, read everything that he says.
Right.
That will give you a hint of how to deal with President Trump.
Right, so you know what to say
and what to expect
and what to expect from him.
Yeah.
Because he's quite, I need to try and join Truth Social. I don't know, it's been quite tough for me.
Please join. All right, just before we go on the program, last week, the NGX was still in the positive. It was up 1.57%. Well, at some point, lost the 120,000 level. But, I mean, when you look at where we're coming from, we still had good numbers. The market cap was up almost 2% for the week. Lost the 76 trillion naira level, but, I mean, we're close at 75.96. The market is doing well. Activity, mostly positive. That's what we had. The sectors, we had good numbers. Oil and gas was the only one in the red. Oh, I have it back here. So we see banking up 2.59, consumer 3.73, industrial 3.92, insurance also. I think there's also data from Insurance Commission. I think more people are looking the way of insurance, not just in the stock, but also, getting the policy. Oil and gas was the only one in the red last week, but top gainers, Namath, Ella Lakes, International Breweries, consumer goods are still trending up. Top losers, Multiverse, Associated Bus Company, O&O, that's why you see the red in oil and gas. Top trades, trust the banks, leading the way. They led the way again last week. So we see the market is really looking good at this period. We see more foreign investors. We saw the FPI looking good. So we'll have more foreign investors coming on. But we, the local investors, we cannot let them beat us. We have to lead the way, because the FPIs, they can just wake up at one news and just get off. And then you see the market crashing. So it's got to be the domestic investors holding this market down. Unfortunately, we saw our FDI last week drop 19%. That's a whole lot. That's a whole lot. So we need more domestic participants. Looking at the smaller unlisted market for last week, it was also positive, 1.86% at 3,248. Market cap almost 1.9, getting to 2 trillion naira. Activity was mostly positive. We saw the deals up 33% for the week. Top advances were Afriland and Geofluids, and decliners CSCS led the way in that. So sentiments are still really positive around Nigeria's financial markets and looking attractive at this time. And I think by 1 p.m., Ladi will be here with Aniti Edith, and they will give you fresh numbers, intraday numbers from the market and around the world of business. I'm Ini John Mekwa, encouraging you to go out there and make some money. To take care.